All right, so let's start the from the second point in here. Every allowed expense results in tax savings. So obviously, if I'm about to increase, if the business's allowed expenses start increasing, then obviously this would decrease the taxable profit. This and hence resulting in decreased corporation tax. So, but here is an assumption. The assumption is that taxable profit never gets equals to zero, because if taxable profit has gone to a zero figure, then obviously any further allowed expense won't decrease your taxable profit, because of course taxable profits are taxed, but taxable loss, but there's no concept of taxable losses, right? So, for example, if the business is making a loss of $50, loss of let's say $50, of course the corporation tax would be zero in this case, because corporation tax cannot become a negative figure, right? Because a negative figure would mean you are going to get money from the taxation authority. So of course this is never going to happen. The taxation authority is not going to pay you back money if you are making losses. So taxable profit, if you are earning profits, then obviously you will be taxed. But if you are earning a loss, if you are creating a loss, then obviously you will not be taxed. So corporation tax figure cannot go to a negative. So that is why you assume that the taxable profit figure never gets equals to zero, and any allowed expense can be deducted, and the tax saving benefit is fully obtained. So this is our assumption here. Then there is the timing factor. What is about the timing? So we assume that the taxable profit is calculated at the end of each year, and tax is paid immediately. Tax is paid immediately. It is calculated at the end of each year, and the tax could be paid immediately, or it could be paid in arrears, meaning 1 year later. So, for example, if it is paid immediately, then we will show the cash outflow at that year for which the taxable profit has been calculated. And for example, let's say it was paid in arrears, then the taxable profit of year one would be shown as a cash outflow in year two. So that is all. This is all about the timing. So the timing should be carefully considered in NPV calculation. So then here it is written that the taxation comes with a good news and a bad news. So what is the good news? The good news is that the tax savings on tax allowable depreciation (TAD). So we talked about TAD in here. So this is the TAD. TAD means tax allowable depreciation. So what is the tax allowable depreciation? One of the allowed expenses is the TAD, not accounting depreciation. TAD is not accounting depreciation. It is different from accounting depreciation. It is tax allowable depreciation. So one of the allowed expense is the TAD. TAD is similar to accounting depreciation. Only difference is that it follows rules set by the tax authority. So tax allowable depreciation is very much similar to accounting depreciation. The only difference is that it follows rules set by the taxation authority. Now let's read the second point in here. When investment is made in non-current asset, when you are making investment in a non-current asset, that is available on that non-current asset, which being an allowed expense results in tax savings. So whenever the business makes an investment in a non-current asset, tax allowable depreciation is available on that non-current asset, which is an allowed expense, and being an allowed expense would result in a decreased taxable profit, which would result in a tax savings. So just like I've shown you here in this example. So let's read further. These tax savings are relevant cash flow and must be included in investment appraisal. So this is just the concept that I have already discussed in the previous video. So this is just repeating. Uh, the important thing is how it works. How does the tax level depreciation works? So method used for tax level depreciation could be straight line or reducing balance method. All right, so very simple. There are no there won't be any new method, as you will be using either a straight line method or the reducing balance method. And then for each year there will be tax savings on that year's TAD, resulting in relevant cash inflow. So for each year, there will be tax savings because of the TAD for that year. Tax allowable depreciation included as in allowed expenses for the purpose of calculation of the taxable profit. Uh, the corporation tax figure would be reduced each year. So obviously this would be shown as a relevant cash inflow each year. And then on the final year, the calculation is different. On the final year, meaning the year of sale, there is no tax allowable depreciation. In the year of sale, in the final year of your investment, there is no tax allowable depreciation, but rather a balancing allowance or balancing charge. So in the final year, there is no TAD, but it could be a balancing allowance or a balancing charge. Now, what is the balancing allowance or balancing charge? Balancing allowance or balancing charge is calculated as is equal to opening written down value. Now, what is written down value? Written down value is the tax written down value similar to the net book value of the asset. This is the tax equivalent of the net book value of the accounting. So for each of the asset, there is the figure in our accounting which was called as net book value. So that figure in taxation rules is known as written down value or tax written down value, TWDV or WDV. So opening written down value for that year minus residual value. So we will be doing this calculation, which will make the concept much simpler and easier for you to understand. So WDV is the tax equivalent of net book value, the same thing that I told. So then there is the balancing allowance. If the balancing allowance incurs, so what is balancing allowance? Is loss on the sale of asset and results in tax savings. And balancing charge is gain on the sale of asset that results in additional tax. So we will be sure I'll be showing the calculation which will make it very much digestible. So let's do this question in the next video. So that was all. That was the second video for the concept of tax allowable depreciation. So in the next video we will be doing this question which will make things very much clearer for you. So bye, we will meet in the next video.